Okay, let's talk about, and this, there might end up being two little videos. Don't worry about this graph yet. The first thing I want to talk about are lag times. We've talked about lag times a little bit already, that is to say the time it takes for the economy to respond to monetary or fiscal policy. There's really two types of lags. There's inside lag time and there's outside lag time. All right, inside lag time is the time it takes before a decision can be made, when policymakers, whether it be fiscal or monetary policymakers, see there's a problem, figure out what the problem is, and then make a decision on what to do about it. That's called the inside lag time. And as you know, fiscal policy, that is to say government action, the inside lag time is a lot longer than monetary policy's lag time. They're much more efficient. The bankers tend to be quicker on what they're going to do. So the inside lag time for monetary policy is small. Inside lag time for fiscal policy, much larger. Oppositely, for outside lag time, this is the time it takes the economy to respond to whatever policy, whether it be fiscal or monetary policy, was initiated. With fiscal policy, inside lag time is real long, but there is a much smaller outside lag time. The economy will feel the effects of fiscal policy in probably at some level less than 6 months. Monetary policy, especially if it's not a drastic monetary policy, will take longer for it to run through the economy. In fact, as we know, it's mostly just affecting prices anyway, although there is some effect on AD. So monetary policy's outside lag time is much larger. Okay, so make sure you know inside and outside lag time. Those are every now and again you'll see a multiple choice question about that, and those are easy questions you got to get. Inside is the time it takes to make a decision. Outside is the time it takes for it to respond. Fiscal policy, long inside, short outside. Monetary, short inside, long outside. And you know, I don't know which one in the end, you know, whether when you take all the lags into account, which one takes the least amount of time, it just sort of depends. But I mean, there are some times where the government acts quickly, and then on the inside and the outside, it's quicker too. So who knows? But let's look at short run. What's going to happen when these two graphs start melding together, right? This unit's about fiscal and monetary policy combinations. And everything you've learned, nothing really new is going to happen, but you're going to see these things tied together, and we're going to add layers to what you're learning about. All right, so in this unit, you're going to learn about, today you're going to learn about the loanable funds graph. But right now, obviously, here's a money market graph, and here's an ADAS graph, right? So let's say the government decides to expand fiscal policy. All right, expansionary fiscal policy, let's say they spend more on the government, right? So the government spending goes up. So as we know, AD will move to AD sub 1. We'll have a higher price level, and we'll have a higher output. So output goes up, unemployment goes down, prices go up, and as you can see, this happens because AD shifts out, okay? So if nothing happens if the monetary policy does nothing, the bank just sits there, what's going to change on the money market graph? So pause it or talk about it for a second, but what's going to happen here? Will MS shift or will MD shift? I hope you said MD will shift. Why will MD shift? MD will shift because, say it out loud, I hope you said because prices went up, okay? Since prices increased, there is a higher demand for money. So the demand for money will shift this way. And as we can see, that will give us a higher interest rate, right? So what is a higher interest rate going to do to AD? Well, what it's going to do to AD is it's going to affect, what portion of AD do you think it's going to affect the most? Remember, AD is G plus I plus C plus X. So what portion of the GDPs are going to affect? Pause, everyone say it. It's going to affect investment. And by affecting investment, it's going to draw AD back some, right? You're going to actually see a reduction of AD, right? Because this is short run. Short run, AD moves out this way, prices go up. So then in response, we're going to have a higher demand for money, which will shift the interest rate up. So in response to the interest rate shifting up, you'll see AD we'll have a new AD, we'll call it AD sub 2, which will hit the supply curve about here, which will be, here's Y sub 2, and you'll have a bit lower price and a bit less output because the I portion of AD, or real GDP, the investment portion has been reduced due to an increase in interest rates. So let's go over that one more time. We have expansionary fiscal policy. The government spends more money, which moves us from AD to AD sub 1. And when that happens, we have higher prices and higher output, right? As a response to higher prices, there is a higher demand for money, so the MD curve shifts out to the right. As you can see, the MD curves out to the right, which pushes interest rates up. As you know, when interest rates are higher, that means less people will invest because the opportunity cost for investing goes up, less people invest, and that will reduce the investment portion of AD, so AD will shift back a little bit, and output will shift back a little bit, price will shift down a little bit. It's not affecting all of AD, but a little bit of it, okay? So, what could the Fed do if they wanted to put it back to AD sub 1? I'll pause. If the Fed wants to go to AD sub 1, then they will have expansionary monetary policy, and that will push MS this way, right? So let's say we'll use a purple marker. Let's say we do MS sub 1, and we will hit the MD sub 1, and now you're back to the other interest rate, right? So this is, before we get a level of funds graph, this is what happens when you have expansionary fiscal policy, right? If the government spends more money. Now, what if they spend less money? It's the exact same thing. If they spend less money, that will drop AD this way. That'll lower prices, and that will lower output. Well, if it's lowering prices, what's going to happen to money demand? It's going to go down. And if money demand goes down, that means interest rates will go down. So what's going to happen to AD over here? At least the investment section of AD, right? It's going to move back up. So if there was, I'll use red. So if we decide to cut government spending from AD, and it goes here to AD, we'll call this AD sub 3. I'm sorry, this is getting to be a pretty busy graph, but you can see prices go down to here, output goes down, and because of this, money demand would go down this way, right? So now you have interest rate sub 2, interest rate sub 2, and that will push AD back up a little bit, all right? If you guys have questions, I'm going to stop it here. I'm going to erase this, draw new ones, and then show you how this affects the level of funds graph. If there's any questions on this, have the teacher stop it and then redo it. Okay? Now here's something I want to make sure the teacher knows. If anyone's not paying attention or not doing this, their name needs to be written down, and I'm going to not let you ever make up a test again. So whatever score you got on multiple choice is what you're going to stay with on this test and the next test. So focus, and if you have any questions, tell the teacher to redo this and see it again. Okay? We've got plenty of class time for it, so stop it, redo it until you guys have it, because when I come back on Friday, I'm going to review it and assume you're going to know it, and if you don't, it's your problem and I have to fix it. So make sure you know it now so my fixing is easier. Alright.